Airbnb stock is down almost 10% in 2025, and investors are asking me if this is an opportunity for 2026. I'll answer that question in this video, reviewing the company's longer-term revenue growth and cash flow history, looking at the returns on invested capital, and updating and sharing with you my proprietary discounted cash flow for this asset-light travel company that's growing significantly in the United States and worldwide.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.
So, looking at Airbnb's history since 2017, we see significant growth with a brief volatile period. Of course, during the pandemic, the travel industry experienced big declines and then a recovery soon after as people made up for pent up demand, being locked up and reducing travel. And you can see 2.6 billion in revenue in 2017 has grown to 11.9 billion in the most recent trailing 12-month period. That's good for a compounded annual growth rate of 22%. Of course, one of the reasons why I've been recommending Airbnb stock and one of the reasons why I've liked Airbnb stock is because of the asset light platform business model. Airbnb doesn't own any of the inventory on the platform, those homes and garages and rooms that are available for rent and for not purchase, but for lease on the platform are brought to the platform by folks that own them. And so these are assets that are worth hundreds of thousands of dollars, if not millions of dollars, and people place them on the platform, and Airbnb gets to benefit as it takes a fee for every transaction on the platform. It brings together guests and hosts and matches them and takes a fee for every transaction, and that's proven to be an attractive option for consumers who prefer this because it customizes to their needs more so than traditional hotels or resorts might do it. That's more of a one size fits all type situation, whereas Airbnb accommodates to customizations when you're traveling with a group or when you're traveling with friends and colleagues, and compared to when you're traveling by yourself and you have different needs every time you travel. Airbnb helps accommodate those needs more specifically than a hotel or resort might be able to do. And the asset light business model has allowed Airbnb to generate excellent returns on invested capital. Since 2021, it's been in positive territory. Of course, 2020, the pandemic year, the initial lockdown stages caused the business to struggle, and then there was a big recovery soon after, and it's been in positive territory ever since that point. Most of its investments go into making the platform more attractive, easing the process to get hosts on board, accommodating for the customer complaints. For when you're staying at an Airbnb, one of the complaints is that, I mentioned earlier that customization is a benefit in some cases, but in some cases it can be a downside. Consumers cannot expect a uniform, similar experience when they book an Airbnb compared to if they stay at a Hilton or a Marriott, where they can expect a more consistent performance in terms of accommodation and service. That's not the case with Airbnb. Sometimes you'll get a host that doesn't provide good service and it can ruin your experience. And so Airbnb has been investing in making up for the areas where it lacks competitive advantage against traditional hotels and resorts, and making the platform more attractive to onboard hosts and guests. Now, Airbnb's cash flow from operations to sales ratio is among the best of any company I follow and has consistently been above 38% since 2021. That means out of every $1 in sales generated on Airbnb, $1 in revenue that Airbnb generates, roughly 38 cents of that goes into cash flow. It's an attractive, very attractive cash flow from operations to sales. It allows the company, and they have been buying back stock. Management has felt their shares are undervalued, and so they've used a lot of this cash flow to buy back shares on the open market. So what about valuation? Well, when using the market multiples basis, Airbnb stock looks cheap. On a forward price to earnings is trading at 25, nearly the cheapest it's been all year, and trading on a forward price to OCF of just 12.6. The stock looks undervalued based on these metrics. And when I go to my proprietary discounted cash flow model, which I updated today, I calculated an intrinsic value for the stock at $175 compared to the current market price of $120. So it looks undervalued on these calculations as well. So all of that being considered, Airbnb stock does look attractive for 2026 and beyond. It's undervalued. It's got great tailwinds, an asset-light business model operating in an industry that's expected to generate roughly $2 trillion in spending in 2026 and expected to grow, albeit cyclically, right? If macroeconomies slow down, Airbnb's growth rate could also slow down in the short term, but longer term, positive trajectory and big growth expected. The biggest risk, in my opinion, for Airbnb are regulatory. People are complaining when their neighbor's house is turned into an Airbnb, and cities have been clamping down on some of these opportunities for Airbnb. That's the biggest risk to growth I see. Besides that, I think Airbnb is a great opportunity long term. Hey, if you value my process for researching stocks, I think you'll appreciate access to my spreadsheet containing my discounted cash flow valuations, which calculate a fair value for over 200 companies. It answers the question, what's a good price to pay for a certain stock? You can get access by joining our channel at the investor tier or above. See the link in the description or click the join button below to learn more.